A recession is a period of economic decline. It's marked by a shrinking economy. This shrinking happens for a sustained period, usually 2 consecutive quarters or more. During a recession, businesses often suffer. They see reduced sales and profits. This can lead to job losses and decreased investment. Recessions are a natural part of the economic cycle. However, their severity and duration can vary greatly. Understanding the causes and indicators of recessions is crucial for policymakers and businesses alike. Recessions don't affect all businesses equally. The economic downturn can create a challenging environment for many, but the extent of the impact varies significantly between small and large enterprises. Small businesses, often with limited resources and cash reserves, can be hit harder. These businesses typically rely on a steady stream of customers and may not have the financial cushion to survive prolonged periods of reduced income. They may struggle to access credit and weather reduced consumer spending. The lack of financial support can lead to closures, layoffs, and a significant reduction in their ability to operate. Large businesses, with their greater resources and diversified operations, often have more flexibility. They can leverage their assets, access credit more easily, and implement cost-saving measures to navigate through tough times. They might handle economic downturns better. Their ability to adapt quickly and restructure operations can be a significant advantage. However, even large companies can face significant challenges during prolonged recessions. They may experience reduced demand for their products, leading to layoffs and cost-cutting measures. The impact of a recession on a business depends on factors like its industry, financial health, and ability to adapt. Companies that can innovate and pivot their strategies are more likely to survive and even thrive in the long run. Economists use various indicators to track economic health and predict recessions. Here are 5 key indicators. GDP represents the total value of goods and services produced within a country. A declining GDP for 2 consecutive quarters is a strong recession indicator. It signals a shrinking economy. The Federal Reserve closely monitors GDP growth as a key measure of economic activity. Consumer Price Index, or CPI, tracking inflation's trajectory. CPI measures the average change in prices consumers pay for a basket of goods and services. High inflation, reflected in a rising CPI, can erode purchasing power. It can contribute to a recessionary environment. The Bureau of Labor Statistics releases monthly CPI data, which is closely watched by economists and policymakers. Producer Price Index, or PPI, early warnings of price pressures. PPI tracks the average change in prices received by domestic producers for their output. Rising PPI can indicate building inflationary pressures, which might lead to future consumer price increases. PPI data provides insights into potential future inflationary trends. Unemployment rate, a gauge of labor market health. The unemployment rate represents the percentage of the labor force that is unemployed and actively seeking work. A rising unemployment rate is a significant recession indicator. It reflects job losses and reduced economic activity. The Bureau of Labor Statistics releases monthly unemployment data, a closely watched economic indicator. Housing market indicators. Signaling shifts in consumer confidence. Housing market indicators, like new home starts and existing home sales, reflect consumer confidence and overall economic activity. A decline in these indicators can signal a weakening economy. The National Association of Realtors and the U.S. Census Bureau provide data on the housing market, which is analyzed for signs of economic health. Navigating the data. Are we currently in a recession? Determining if we are currently in a recession requires careful analysis of multiple economic indicators. While some indicators might show weakness, others might remain relatively strong. Here are the current indicators as of August 8, 2024. GDP growth rate, 2.1%, unemployment rate, 6.5%, inflation rate, 3.2%, consumer price index, 0.1%, and the producer's price index, 0.2%. The National Bureau of Economic Research, or NBER, officially declares recessions in the United States. They use a holistic approach considering various factors beyond just GDP. And although we have some disagreement between indicators, it is believed that we are headed towards more agreement. You need to hear this if you're a business owner looking to thrive in challenging times. Businesses can take several proactive steps to mitigate the impact of a recession and ensure long-term sustainability. These strategies include increasing marketing effectiveness. Enhancing your marketing efforts can lead to more leads and potential customers. This involves targeting the right audience and using data-driven approaches to maximize your marketing ROI. Improving sales skills and processes. Investing in sales training and refining your sales processes can boost conversion rates and drive revenue growth, even in tough economic times. Controlling costs, reducing unnecessary expenses, and improving operational efficiency can help businesses conserve cash. This involves scrutinizing every aspect of the business to identify areas where costs can be cut without compromising quality. Managing inventory. Optimizing inventory levels to match demand can prevent overstocking and minimize losses. Efficient inventory management ensures that capital is not tied up in unsold stock, which can be particularly detrimental during tough economic times. Strengthening customer relationships. Focusing on customer retention and loyalty becomes crucial during economic downturns. Building strong relationships with customers can lead to repeat business and positive word of mouth, which are invaluable during challenging periods. By implementing these proactive measures, businesses can increase their resilience and position themselves for recovery. It's not just about surviving the storm, but also about emerging stronger and more competitive when the economy rebounds. Building resilience. Long-term approaches for recession-proofing your business. In today's volatile economic climate, it's crucial for businesses to think beyond immediate survival and focus on long-term strategies that can help them thrive even during recessions. Beyond short-term strategies, businesses can adopt long-term approaches to enhance their resilience, diversifying offerings. This means not putting all your eggs in one basket. Expanding product or service lines can reduce reliance on a single market segment. By offering a variety of products or services, businesses can tap into different customer bases and revenue streams, thereby spreading risk. Building a strong online presence. In the digital age, having a robust online presence is not just an option, but a necessity. Investing in e-commerce and digital marketing can help businesses reach customers beyond their physical location. This can open up new markets and opportunities that were previously inaccessible. Developing a robust financial plan. Financial stability is the backbone of any resilient business. Maintaining adequate cash reserves and securing access to credit can provide a financial cushion during tough times. This ensures that the business can continue operations even when revenue streams are disrupted. By embracing adaptability and long-term planning, businesses can weather economic storms and emerge stronger. Flexibility and foresight are key to navigating the uncertainties of the market and ensuring sustained growth and success. Conclusion. Embracing adaptability and preparedness in an uncertain economic landscape. Recessions are an inevitable part of the economic cycle. By understanding the indicators, impacts, and strategies for mitigation, businesses can navigate these challenging times. It's crucial to stay informed, adapt to changing circumstances, and prioritize long-term resilience. Call to action. Join the conversation on economic resilience. What steps are you taking to prepare your business for potential economic challenges? Share your thoughts and insights in the comments below. Don't forget to subscribe for more informative content on navigating the ever-changing economic landscape.